Imagine waking up to headlines that the Federal Reserve did nothing and that this nothing could shake up your wallet. Well, that's exactly what happened. In early May, the Fed made no change to interest rates, leaving its benchmark rate at 4.25 to 4.5%. That's the third meeting in a row with no rate move. It might sound uneventful, but this quiet pause masks a high stakes balancing act that affects your money and job. In this video, we'll cover the Fed's pause, their outlook on inflation and jobs, what they're signaling about future rate moves, and most importantly, how it all impacts you. By the end, you'll understand how these big Fed decisions trickle down to your everyday life, whether you're borrowing, saving, or earning a paycheck, so you can make smarter moves in the months ahead. The content in this video is for informational and entertainment purposes only and should not be construed as financial advice. I am not a licensed financial advisor. All information presented is general in nature and does not address the circumstances of any particular individual or entity. Viewers should consult with a qualified financial advisor before making any financial decisions. Let's start with what the Fed just did. First, the headline, "The Fed is in a holding pattern." The Federal Open Market Committee voted unanimously to leave interest rates unchanged. That keeps the federal funds rate target at 4.25 to 4.5%, the same level it's been since last December. After an aggressive series of rate hikes in 2022 to 2024, the Fed is now effectively hitting pause. Why pause now? The Fed Chair Jerome Powell and team noted that the economy is still chugging along. In Fed speak, recent indicators suggest that economy activity has continued to expand at a solid pace. In plain English, the economy is growing steadily. They pointed out the unemployment rate is low and stable, and labor market conditions remain solid, meaning jobs are plentiful and hiring is holding up. However, they also cautioned that inflation remains somewhat elevated. In short, the Fed thinks their past moves are working, but they're not declaring victory yet. Now, let's talk about inflation. Is the worst behind us? Now, about inflation, the big reason the Fed hiked rates so much before. The good news is inflation has cooled way down. In April, headline consumer inflation was about 2.3% year over year, the lowest since early 2021 and almost at the Fed's 2% goal. Just a year or two ago, prices were rising 5% or more annually, so this is a huge relief. In short, the price surge is finally back under control. However, the Fed isn't popping champagne yet. A recent flare up in trade tariffs could push prices up again later this year. Those import tariffs, essentially taxes on goods, tend to make things more expensive for businesses and consumers. Economists warn inflation could creep back above 3% later this year. The Fed's mindset? Great, we got inflation down, let's make sure it stays down. They're keeping rates high for now to ensure the price dragon stays in its cage. The job market, still strong, for now. Meanwhile, the job market, the other half of the Fed's mandate, remains pretty strong. The unemployment rate is around 4.2%, which is low by historical standards. It's been roughly in the 4% range for the past year. And despite those higher interest rates, employers are still hiring. The United States added about 177,000 jobs in April, which shows businesses haven't slammed the brakes. Wages are growing too, but at a moderate pace. Average paychecks are roughly 3.8% higher than a year ago. With inflation down in the 2 to 3% range, those raises are actually giving workers a bit more buying power. In fact, real wages adjusted for inflation are up about 1.4% over the last year, meaning workers are finally gaining ground instead of losing it to price hikes. The Fed is watching the job market closely for any cooling. They want job growth to slow just enough to keep inflation in check, but not so much that people start losing jobs left and right. So, what's next? The Fed's message lately is basically wait and see. Powell has stressed that they will monitor incoming data and are prepared to adjust policy if needed. Think of the Fed as a driver with one foot ready to brake and the other ready to gas it. They're waiting to see if the economy slows or accelerates. A big reason for caution is those new tariffs we mentioned. Import taxes can be a double whammy for the economy. They can make goods more expensive, pushing inflation up, while also slowing demand and business investment, which can hurt growth and jobs. Because of these mixed signals, the Fed is content to stay in a holding pattern for now. They'll wait for clearer signs of where inflation and the economy are heading before making their next move. What about rate cuts or further hikes? Fed officials have signaled that no rate cuts are likely through the summer. A month ago, many on Wall Street were betting on a cut by July. Not anymore. Consider that myth busted for now. Looking further out, if inflation keeps improving and growth slows, the Fed might start trimming rates late in the year. In fact, their March forecast penciled in roughly a 0.5% rate cut by year end. But that's far from certain. They won't cut unless they're certain inflation is defeated and the economy can handle lower rates. So for now, expect policy to remain in this holding pattern, with an eye towards possible relief later in the year. Alright, so the Fed is pausing. How does that affect you directly? Here's the impact. Borrowing costs. Still high. If you have credit card debt or a variable rate loan, you've felt the sting of past rate hikes. And that's not going away yet. Credit card APRs are hovering around record levels. The average credit card interest rate is about 22% right now, an all time high. Carrying a balance is costly, so try to pay it down if you can. Other loans are pricey too. Mortgages are around 6.9% for a 30-year fixed, and auto loan rates are high as well. At least the Fed pause means things won't get worse, but they also won't get much better until rate cuts actually arrive. In short, borrowing will stay pricey for now. Savings and CDs finally rewarding. On the flip side, savers are finally getting a break. High yield savings accounts are offering around 4 to 5% APY now, a huge jump from near zero not long ago. This interest actually beats inflation, so your money in the bank is growing in real value. It's a great time to beef up your emergency fund or stash cash in a CD because your money is working harder for you than it has in years. Job security and wages. For workers, job security remains solid. No massive layoffs, and with low unemployment, you still have some leverage. Wage growth isn't spectacular, but around 3 to 4%, it's slightly above inflation, so your purchasing power is finally inching up. If the economy cools later, the job market could weaken too. For now, enjoy the stability. So here's the bottom line. The Fed is holding steady on rate hikes to see if inflation fighting work is truly done. They've pressed pause, aiming to curb inflation without causing a recession. For you, that means interest rates on loans remain high, though not climbing higher. And savings yields are the best they've been in a long time. What happens next depends on upcoming data, especially on inflation and jobs. We'll be watching those reports right along with the Fed. If you found this breakdown helpful, please hit that like button and subscribe for more updates on what's happening with the economy and your money. Let me know in the comments, do you think the Fed is making the right call by holding rates? Are you feeling the effects of these policies in your own life? I'd love to hear your thoughts. Thanks for watching, and I'll see you on the next one.